Many big automakers have big plans for electric and self-driving vehicles. The stocks of the public companies in this group are in an ETF for electric and autonomous vehicles. That ETF is called the Global X Autonomous and Electric Vehicles ETF. The ticker symbol is DRIV, and it is designed for investors who like to focus their investments in this industry. Well, this ETF fell 15% in September alone to make September its worst performing month ever. So what does this mean for the future of electric vehicles? What does it mean for legacy automakers like Ford and General Motors? What does it mean for Tesla? What does it mean for the future of transportation? What does it mean for the US economy? And what does it mean for the future of the United States? But before we get into that, please hit the like button. Please leave us a comment below, we would love to hear from you. Please hit the subscribe button and the bell icon so that you are notified of upcoming videos. The sudden drop in the share price of the DRIV ETF comes as the United States economy teeters on the brink of a recession. It comes as inflation continues to rage in almost every country in the world. And the United States Federal Reserve continues to aggressively raise interest rates to fight inflation. Electric vehicles are still much more expensive than gas-powered cars. Investors are clearly concerned that could make electric vehicles even more expensive, especially for customers who have to borrow money to buy a car. Car prices in general are higher than ever. Tight supply chains have caused some dealers to demand additional premiums on top of the list price. The average price of a new car in the United States is now more than $46,000. Consumers are already beginning to balk at those high prices, especially as inflation drives their other expenses higher, and especially as interest rates continue to rise, said TrueCar analyst Zach Krell. We're seeing consumers faced with the reality that to afford the same vehicle at the same monthly payment as last year, Krell continued. They are forced to increase their down payment, which is creating new affordability challenges, Krell said in a statement on Thursday. With increasing interest rates, affordability is being tested, Krell also noted. A recession in the United States will cause a decline in automakers' profits. That will cause share prices to fall. Ford is down 27% in September. General Motors down 18%. Volkswagen down 13%. All of these companies' shares are represented in the DRIV ETF. The shares of the suppliers and startups in the EV and autonomous driving space are also included in the DRIV ETF. In fact, those stocks comprise of the DRIV ETF portfolio. A recession would make it harder for auto companies to invest in new technologies. And higher interest rates would make it more expensive to borrow money for new technology development. Economic weakness would make it more difficult for those smaller companies to raise additional capital from outside investors. The established major automakers are well capitalized and can ride out a recession. But smaller companies and startups in the EV and self-driving spaces could encounter tough sledding. Some of the names that have attracted investor attention over the last couple of years are still a long way from sustainable profitability and are likely to need additional cash infusions over the next few years. For example, EV battery startup QuantumScape is down 21% in September. QuantumScape does not even have revenue, much less profits. Luminaire Technologies, which makes lidar systems, is down 13% in September. Nikola, which makes heavy electric trucks, saw its stock tumble 35% last month. While many companies pile into the electric vehicle and self-driving space, Toyota takes a more measured approach. Toyota is the pioneer and reigning champion of hybrid vehicles. For its part, Toyota simply does not think battery electric vehicles are the only solution for achieving carbon neutrality. To be sure, Toyota is in the electric vehicle business and has set a goal to produce 3.5 million electric cars by 2030. That would amount to over one-third of its model lineup at that time. Environmental organization Greenpeace has criticized Toyota for its feeble decarbonization efforts. This is despite the fact that the Prius comprised only 1% of its overall sales. Greenpeace ranked Toyota as making the least decarbonization progress of any large automaker. General Motors, Ford, Volkswagen, and other legacy automakers have committed to investing billions to develop battery electric cars. Toyota has dragged its feet in committing to investments in electric vehicles. Toyota prefers to invest in a portfolio of electrified vehicles. This includes traditional hybrids like the Prius as well as the new bZ4X electric crossover. This plan has caused environmentalists and governments to question Toyota about its commitment to industry decarbonization. Regardless, Toyota has kept its commitment to be carbon neutral by 2050. Toyota executives claim that not all areas of the world will adopt electric vehicles. This is because of the high cost of electric vehicles and the lack of infrastructure. Toyota announced plans to invest $28 billion in a lineup of 30 battery-powered electric cars by 2030. And it is keeping up its investment in hybrid electric vehicles like the Prius. Toyota also announced an investment of $5.6 billion for hybrid and all-electric battery production in the United States and Japan. But it is far less than the investment from General Motors and Volkswagen. Worldwide total vehicle sales for Toyota in 2021 was 10.5 million vehicles. Those cars were sold in approximately 200 countries. That is more than any other car maker in the world. Volkswagen, by comparison, sold 8.9 million vehicles in 153 countries. General Motors sold 6.3 million vehicles. All electric vehicles are one solution, not the solution, for the company's goal to become carbon neutral, Toyota said in a statement. In the distant future, I'm not investing assuming that battery electrics are 100% of the market. I just don't see it, said Jim Adler, founding managing director Toyota Ventures. It really will be a mixed market, Adler added. Toyota expects different areas of the world to adopt electric vehicles at varying rates, continued Adler. Available energy, infrastructure and raw materials needed for the batteries to power the vehicles, Adler also said. Toyota has also made high-profile investment in hydrogen fuel cell cars. The Toyota Mirai has been selling in California for almost 5 years. Fuel cell vehicles face the same electric cars, namely cost and lack of infrastructure. Prices of essential materials such as lithium, cobalt and nickel have skyrocketed in the past year. That is something of an endorsement of the cautious strategy taken by Toyota. Toyota also claims that there just aren't enough rare earth minerals to go around. What do you think? Please hit the like button. Please leave us a comment below, we would love to hear from you. Please hit the subscribe button and the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.